Hello, everyone. Welcome to the Millennial Home Buying Guide webinar. We're going to give everyone about another 1 or 2 minutes before we get started, so just sit tight and wait for our announcement to begin. Okay, everyone, welcome to the Millennial Home Buying Guide webinar. My name is Brian Griffith. I'm the Digital Social Media Specialist here at Greater Alliance, and we're going to get started with the webinar now. So before we begin, I just want to go over some webinar resources that are available to you. At any given point, feel free to ask questions. On the right-hand side of your screen, you should see some sort of prompt with a question area. Feel free to ask questions throughout the entire presentation. There will be a dedicated Q&A at the end of the webinar, so we won't actually answer questions until that part, but feel free to ask at any time during the presentation. We also have 2 handouts available to you about the home buying process, and especially if you're a first-time home buyer. So please feel free to check that out. Those are really good resources for you. I don't believe we have any polls in this webinar, so you can ignore that third point. And then just so you know that the webinar will be recorded and will be sent to you through email, and we're also going to be uploading it to YouTube. So in case you have to get up, or if you missed, or if you have to leave for any reason, don't worry, you'll have a copy sent to you so you can review all the information afterwards. And so with that, I want to introduce today's presenter. She's actually been a lot of webinars, so I'm happy to have her back. Jasmine, she's been a certified HUD counselor for 12 years, and over 18 years of experience in the housing and mortgage industry. She specializes in first-time loan, LMI, and community development. Jasmine has also assisted with various grants, including Savings Match Program and the Financial Strategic Planning. Yasmin is passionate about building the community and social services and received her degree in business administration from Berkeley College. So with that, I introduce Yasmin to take care of the rest of the presentation.
Okay, thank you, Brian. So thank you, everyone, for joining us today. I'm really proud of all of you that are witnessing what we have here to offer and actually planning for your future and future investment for yourself and your family. Again, Brian has stated that it's important for you to ask any questions. You can ask them at any time. The way that I would recommend for you to do is thing that pops up into your brain, just type it, ask it before you forget it. And then later on, once we've concluded the presentation, I'll be able to go over all of the questions and answer them for you. Okay, so let's just dive right into today's agenda. We're going to discuss how to do the math for a mortgage, how you're going to stay organized, how to save for the down payment, expenses, how to shop around, how to study the neighborhood, and tips for you millennial home buyers. At the end, we're going to discuss home buying programs and questions and answers. Programs including down payment assistance and what type of programs we have for mortgages. Okay. So let's begin with how to do the math, okay, where to start. You have to be sure you're in a good position to be able to afford a home. So it's important for you to put the numbers down on paper, okay? Now, what do I mean by that? To be sure you're able to be in a position to be able to afford a home, put the numbers down on paper. Lenders usually follow the 43-47 rule. So that means that for the front end ratio, if that's the 43, monthly payments should not exceed 43 of your gross monthly income. So mortgage payments, including property taxes, homeowners insurance, that should not take up any more than 43% of your gross monthly income. Now, 47% is you have to add your total monthly debts, including college loans and credit card debts, which should not total more than 47%. If you go over, then you do run the risk of foreclosure. So let's use an example. Let's use numbers so that you can understand it a little bit better. So the 43%, so that's the front end ratio. So what that calculates is just your principal, interest, taxes, and homeowners insurance. So let's just say that you make about $30,000 a year. Okay. Now, if you divide that by 12, then that means that you make about $2,500 a month. Now, if you multiply that by 43%, that means that your total principal, which is the amount that you're financing, interest, taxes, homeowners insurance, and mortgage insurance should not exceed a payment of $1,075 per month. So that's one calculation. Now we have to take into consideration your total expenses, meaning, let's say you have a car payment. Let's say you have and the car payment is about, let's say, $300 a month. And we have credit cards, and they're about maybe $50 a month. So remember, all we see is what your total liabilities are reporting on your credit report, not what you pay for your cell phone, for rent, for your insurance, personal insurance, things of that nature. Those numbers we don't even take a look at. The only numbers that we do take into consideration to be able to determine the back-end ratio is the principal, interest, taxes, homeowners insurance, that's the PITI, okay, it's called PITI, and your monthly debts that are reporting on your credit report. So let's say, for instance, that's a total of $350, okay, plus we add the $1,075, okay. So if we add those debts, that's a total of $1,425 a month. Now, that number should not exceed the 47% rule. Okay, so in other words, the front end ratio is just taking the principal, interest, taxes, and homeowners insurance divided by your gross income, and then the back end ratio is taking your principal, interest, taxes, homeowners insurance, and your monthly debt obligation divided by your gross monthly income. Okay, now luckily here at Greater Alliance, we do go up to 50% of your gross monthly income. So that means, let's use the same analogy. Let's say your income is $2,500 a month. We do accept up to 50% of that. So that means that you can afford a mortgage payment of $1,250. Okay, but remember that's just a front end ratio. So the back end ratio, you have to deduct, let's say your car payment, and let's say that's $300, and let's say your credit cards are $50. So you have to subtract from the $1,250, you have to subtract the $300 minus the $50. So that means that you can afford a mortgage payment of $900. Okay, so that's principal, interest, taxes, and homeowners insurance, and that is your true and actual mortgage payment per month. Okay. So one of the other criteria that I do also recommend for you to do is to always stay organized from the beginning. So let's say, for instance, if you decide to begin your mortgage process now and you want to purchase a home, let's say in 3 months or 4 months, you have to start becoming organized as of right now. You have to start getting into the right stepping stone, just like you are right now. So I'm really proud of you. So in order to be able to stay organized, there are a few things that you should consider in doing. And that's basically gathering up documentation. So you're going to need 2 months' most recent bank statements in order to be able to apply for a mortgage, okay? What I recommend for you to do is try not to have a lot of activity, meaning large deposits reflecting on your bank statements, because if you have any large deposits, then we will have to source it. As long as they're coming from your job and we can see where that money is coming from, or let's say, for instance, your income tax returns, and we can confirm where that money is coming from, then that's no problem. You can have those types of large deposits. But if you're depositing cash, then that's not a good idea while you're going through the mortgage process, because the underwriter is going to ask, well, where did this money come from? Okay. You will also have to gather federal tax returns for the past 2 years. You're going to have, let's say, your driver's license, or that's active, okay, cannot be expired. A verification form from your employer. Well, that's something that we can gather on your behalf. And that's just basically a verification of employment. Where do you work? How long have you been working there? How much do you receive per hour? How much have you earned year to date as far as your overtime is concerned? Okay, but that's something that we can do on your behalf once again. And we also need the past 2 years W-2s. So 2017 and 2018 W-2s from all employers. I'm also going to need a recent up-to-date credit report. Now, as a side note, you can obtain your credit report by going to annualcreditreport.com. Okay, you are entitled to take a look at your credit report once a year for free without it negatively impacting your credit score. So again, you can go to annualcreditreport.com to be able to obtain that information. Okay. So again, it's important to just have all of these statements and all of this information in a folder. So we're also going to be asking for 30 days pay stubs. So the most recent 30 days is going to be needed as well. Okay, so another one of the questions that millennials have is, do you happen to have enough money for down payment? It's important to put as much money as you can for the down payment, because that's going to be able to determine the duration of your mortgage as well as its monthly rate. Okay, the more money you have for down payment, obviously, is the better. If you don't have any money for down payment, well, it's a concern. You should always have something. There are various programs like the 3% down payment option. You have the 10% down payment, 15%, and 20%. So what do I mean by that? So let's say, for instance, you find a home and the home is on the market for $250,000. You will at least have to have from your pockets about $7,500. Okay, so it's like giving a down payment towards the purchase of your home. So usually what happens is that when you make an offer on the home, you have to put some money down. So that's called earnest money. That money goes to your realtor, which then goes to the seller's attorney, and they'll hold it for you until the closing date. Okay, so after the housing bubble, less lenders are offering 100% finance option. For this reason, it's important to put as much money as you can for the down payment, which will determine the duration of your mortgage as well as its monthly rate. Home buyers typically put about between 3 to 20% of the total mortgage cost. If you're putting down more upfront, your total loan amount will be lower, meaning your mortgage payment will be reduced. The more money you put, the lower the mortgage payment on a monthly basis. Okay, and the less you have to finance. So you have to make sure you have enough for a down payment. And the reason why it also benefits you is because increasing your down payment will also make you eligible for loans at a lower interest rate. And furthermore, when you put more money down at signing, mortgage lenders will be able to lend you more money. So the reason why we'll be able to lend you more money is because of that back-end ratio that we were talking about a few moments ago, right? So remember, we do use the up to 50% gross monthly income rule, but the more money you put down, that means that you can afford more of a home, so the purchase price is increased, okay? Just to give you a little bit of an explanation on that. There are some expenses you should not overlook, okay? So don't overlook property taxes, property insurance, closing costs, and other expenses, okay? One of the things that I do recommend for you to always do when you start searching for a home, first thing is obviously the sales price. How much are these sellers selling this home for? And secondly, take a look at the property taxes. The higher the property taxes, the lower the purchase price will be, or the loan will be. Why? Because the majority of the principal, interest, taxes, and homeowners insurance, remember that PITI that we were just talking about, that mortgage payment is going to be increased if you choose a home with a high property tax bracket. Again, so your loan amount will be reduced because a large portion of that amount, let's go back to the $1,250 example. A large portion of that amount that you're able to finance is going to go towards the property taxes as opposed to the principal. The principal is the amount that you're going to finance. Okay, so these necessary expenses can quickly outprice the home you're looking to buy. So you have to calculate the home insurance, property tax collection rates, and which differs from state to state. So in New Jersey, property taxes are really high, depending on the city. So that really varies. But if you decide to, let's say, for instance, purchase in Georgia, in Florida, South Carolina, so on and so forth, those states, the property taxes are not as high as New Jersey. Okay, you have to figure out ways to reduce the insurance rates, such as making upgrades to the home and maybe a home alarm in the new home will definitely assist you in reducing your insurance rate. Now, you should also consider enlisting the same insurance company that covers your automobile. So you can bundle those two up, your car insurance and your home insurance, and typically they'll give you maybe a 25% reduction on both insurance costs. And tip number 4 is that all All in all, closing costs can put a hefty dent on your wallet, so utilize a closing cost tool to estimate how much these charges will be able to affect you. So if you start shopping around from bank to bank to bank, one of the things that I highly encourage you to do is to take a look at the closing costs. Okay, a lot of lenders charge for processing, origination, they charge points, they charge lock-in fees. So you have to really take a look at the closing a loan estimate so that you can itemize and you can shop around for different types of loans and take a look at their closing costs. Now, luckily here at Greater Alliance, we do not have any closing costs such as the origination or processing or underwriting fees, but we do have what is called those third-party fees, which are the fees that are being charged to us. We have to charge you. Typically, our closing costs are between $3,000 to maybe $6,000 less than any other major lender. Again, because we are nonprofit and we don't charge you for those fluff fees. Okay. Shopping around, while it may be time consuming, it's important to get a grasp on comparables in the area. So ways that you can compare homes are, first and foremost, enlist with a real estate agent. One way is to enlist with the assistance of a real estate agent. You can choose an independent agent or one from a top real estate agency. Now, it's always important to have a realtor on your side because they're going to be the ones who have that fiduciary contract with you. They have to protect you. And best of all, you don't pay for those services. The seller pays for both realtors, the realtor who puts the home on the market and the realtor who sells the property. So just make sure that you have a really good realtor. How can you tell? Well, if the realtor answers your calls at all times, if they answer your questions, and we're going to enter into details in a few minutes with regards to a good real estate agent. Also, number 2, home comparison websites. You can use Zillow, Trulia, and Home Again. There are a few websites that you can use to conduct detailed property searches while comparison shopping. Also, multiple listing service. So it's important for you to familiarize yourself with a multiple listing service, including the one offered by the National Association of Realtors to access comprehensive real estate data and insights. So a few websites that you can utilize to find a home. Okay, you can use Realtor.com. They offer statistics and neighborhoods, a huge assortment of listings, apartment listings, and local mortgage rates. Homefinder.com is another good one. It's one of the only real estate sites that has its own open house tab. The same goes for home foreclosures and auctions. Be very careful with those, though. If you move forward with a foreclosure or homes that are in auction, you have to make sure that when you speak to the realtor, your realtor, ask them if whether or not those properties can pass what is called a certificate of occupancy. Okay, a certificate of occupancy is something that typically the realtors get almost at the end when we're at the closing table. And that's basically to ensure that the smoke detector, the monitors, that the property doesn't have any type of hazards in there and that the property is habitable. Okay. You can also go to Zillow.com. The best thing about Zillow is how specific you can get in your search. If you're looking for an oceanfront home with a garage, pool, a good school district, and 3 bedrooms, you can put all these search items into the More tab, and chances are Zillow will find your home. A great tool that Zillow also has is that if you scroll down and hit the property tax bar, you're going to be able to see how much property taxes are for that particular home. Okay, so you can also refer to Zillow.com for property taxes. Remember that. You can go to Redfin.com. It's claim to fame in finding you the best real estate agent. This is because Redfin is actually a broker, so they promote their own real estate agent. So what I love about Redfin is that, let's say, for instance, you already own a home, or if you want to have a good idea on what a property is currently worth, Redfin is the way to go. They are the ones that are like 99% accurate on what the value of the home truly is. Okay. You can also go to dweller.com. That's best for those who are in the process of relocating or who are just thinking about trying their hand in a different city. Trulia.com is one of the biggest pros is when Trulia is also an app. It's easy to navigate and actually fun to use. This feature has also made Trulia an up-and-comer in the renting world. What I personally love about Trulia is that Trulia gives you the most up-to-date information, meaning they'll tell you exactly, if the property is still on the market, whereas maybe Zillow will not give you the most up-to-date information, like if the property is pending sale or if the property has already been sold. So you have a few things now to think about. You can go to realtor.com, but basically that's for apartments and things of that nature. The three that I would highly recommend is Zillow.com, just to be aware of the property taxes, Redfin to get a good estimate of what the property is really worth, and Trulia to see if whether or not the property is still on the market. Now, I'm going to add another resource. It's called HomePath. Okay, so you get the best of all worlds with homepath.com. HomePath will actually let you know which properties have been foreclosed, and they're Fannie Mae real estate owned properties. So some of them have been rehabbed, some of them are in really good condition, but these are properties that have already been foreclosed and on the market. Again, it's HomePath. Okay. All right. Study the neighborhood. You need to know and understand which neighborhood is best for you, which can help you to gauge your home's resale value. What I personally did when I purchased my home is once I took a look at it, I didn't just go once to take a look at it inside and out. I also went during the day in the morning, like at 8 o'clock or 9 o'clock in the morning, just so that I can get the feel of the neighborhood and the traffic. Okay. I also went back at 7, I went at 8, at 9, at 10, 11. I went on the weekends just to see what the neighborhood is really like. Because if you go to the property just once, you're going to just fall in love with it immediately. But you really need to know what you're getting yourself into, because remember, this is a 30-year investment. Not saying that necessarily that you're going to live in the property for 30 years, but if you're going to live in there for 2, 3, 5 years, you have to take a look at it, because if you decide to move out, then remember, you're going to want to rent it, and you want to just make sure that you're in a good neighborhood. Okay, so love at first sight can really lead you into trouble. So you need to know and understand which neighborhood is best for you, which can help you gauge your home's resale value. So let's say, for instance, you don't know why that person is selling the home. So you have to do your due diligence and check out the neighborhood. Because if you decide to sell it, you're going to have to know the pros and cons of the neighborhood. Okay. By knowing the value of surrounding properties, you will also know if it's the nicest home you want outprices the other homes. So location, location, location. You've always, heard of that. So it's not a good idea to necessarily buy the biggest and the best home in the neighborhood, but more so maybe take a look at something that a home that's more affordable, maybe something that's smaller that you can turn into something big and beautiful one day. Okay. While it may appear like a good idea, your home won't appreciate at the same price as the others around you. So it may be difficult to unload once you're probably ready to buy your next home. So again, it's very important for you to take a look at the neighborhood, take a look at the comps in the area, and just think about the renovations that you can make to the home, such as maybe you want to upgrade your bathroom or upgrade your kitchen. Would it be worth it if you were to do all those renovations because of the value of the home? Will it actually increase? So these are things that you really want to think about. Okay. Also, it's important for you to shadow the property inspector. In addition to the home appraisal, it's important and essential to enlist a qualified property inspector. So a home appraisal is someone that goes out to the property and takes a look and see if the property is worth the price that the seller is selling it for. So let's say you like the home and the seller of the home is selling it for $250,000. But the appraiser goes out and says, well, you know what, this property is not worth $250,000. This property is worth $230,000. Then guess what? We're only going to be able to let you borrow $230,000. So it's the lesser of the two, the appraised value or the sales price. Okay. Now it's also important to shadow the property inspector because you want to know how the property, the details of the property and how things work and certain gadgets that they may have, or how, what light switch pertains to what room and how to work that. So it's important to, and it's essential to enlist a qualified property inspector because the professional contractor will evaluate the quality and safety of the home. This part is crucial because, as the adage goes, every home has its secrets. Under no circumstances can you enter a mortgage blindly without knowing its true condition. So, in other words, it's not an obligation, meaning we don't require for you to have a home inspection, but I highly recommend it because let's say you're trying to save $300, $400, $500 because you don't want to spend it on a home inspector, but realistically speaking, you don't know what's behind the wall. You don't know if the property has termites. You don't know if whether or not this property has other structural problems, right? And then once you purchase the home and then you find out about all these structural problems or the furnace goes out, it's going to cost you a lot more than $300, $400, $500. Okay, so it's important for you to have this home inspection so that you can also use this as a negotiating tool, right? So let's say the inspector says, well, you know what, this roof is caving in, or this roof has about 1 to 2 more years of life expectancy, or the furnace is old, it's about to give out. Then the seller can probably give you $2,000, $3,000, $5,000 credit, right? And all of this can be given to you before the closing. So that's why it's very, very, very important for you to hire an inspector. And again, shadow the inspector so that when the inspector puts any problems on paper, you know exactly what they're talking about and exactly what you need to target once you purchase this home. The inspector will also carefully look at the structural and mechanical aspects of the property. Again, you need to be on point with regards to whatever is going on with the property. He or she will also raise a red flag regarding current safety and security concerns. So let's say, for instance, the property has a fireplace, right? And the fireplace isn't up to code. It can cause a fire hazard. So these are things that you want to know, you want to be aware of. You want to know whether or not you need to receive a credit so that they can repair it, or the seller can also make the necessary repairs before you purchase this property. Okay. He or she will also be able to identify potential hazards such as asbestos, lead-based paint, or mold. Okay, because again, these are items that will have to be repaired before you purchase the property. Okay, so it's not money that's going to come out of your pocket. It's going to come out of their pocket. And to help you along, the U.S. Department of Housing and Urban Development, HUD, has put together a list of 10 important questions to be able to ask your home inspector. Okay, and we will provide you with that website later on as well.
Yes.
Okay. Now, 5 tips for millennial home buyers. these are tips that to master the home buying process. Okay. Number one, try to pay off as much student loan debts and other debts as possible. Now, when I take a look at a person's debts, and let's say, for instance, you have student loans, we do calculate up to 1% of your total debt. So let's say, for instance, you have $10,000 or let's say $1,000 in student loan debts, then we only use, let's say, $10 of that to be able to determine the debt to income ratio. Now, what you also can inquire about, if you do have a lot of student loan debts, inquire about what is called a income-based repayment, IBR. So that will also help reduce the student loan payment per month. That'll definitely benefit you because then you'll be able to borrow more money. Okay, so again, your student loan debts and your other credit card debts are very important for you to, start tackling those and paying those off so that you can borrow more. Step number 2 would be save for the down payment. I know it's hard. It's very hard, but what you can do is maybe every time you receive pay, just have at least save at least 10% or 6%, whatever you can, and just start putting that aside, or just having a savings account just dedicated for your home. And from your paycheck, just have that automatic deduction go right into your savings account. Also, when it's time for your income taxes, save your income taxes. You can utilize that as well for your source of down payment. Okay. Number 3, stand out in a competitive market. Okay. By maybe writing a letter and saying, how important this house may be for you and your new family. Number 4 is find an affordable house in a seller's market. So just take a look. Right now, it is a seller's market because there's not a lot of inventory. Inventory meaning a lot of homes for sale. So it's important for you to do your due diligence, take a look at all of these websites and see which property or which home is most affordable depending upon your income. Okay, and gain experience with the buying process. What are the things to look into? Get prepared. So the only way you'll be able to get prepared is by knowing what exactly you need to do. So start off with taking a look at your credit report, like I mentioned before. Go to the annualcreditreport.com. Take a look at the things that you need to tackle off first. So what I would do is I would, take a separate sheet of paper and write down which cards have the highest interest rates and start paying those off first. Okay. Then once you finish paying off one card, use those monies to be able to pay the second highest in interest rate, and then so on and so forth. So that this way you can pay off your debts sooner rather than later. Okay. Tips to pay off student loans and other debts, meaning your credit cards, car payments, and things of that nature. If student loans weren't enough, consumer debts has postponed the home buying dream of many millennials. In fact, NAR reports that second to student loans, the 2 expenses that delayed savings for down payment were credit card debts by 32% and car loans by 32%. So there are ways that we can help you pay your debts. If you have a lot of debt or little debt, you can also partner up with greenpath.org or navicoresolutions.org. They are HUD certified counselors who will be able to counsel and educate you and help you navigate the process and make informed decisions. Plus, it's a free service for all of our members. So what's good about GreenPath and Navicor is that they are housing counselors and they are credit counselors. So they will be able to let you know exactly what you need to do to be able to increase your credit score, okay, and how to pay off your debts. what programs are available for you to be able to pay off your debts, and they will be also able to tell you what grants are available in the area that you're looking into purchasing. Now, right now, you are in a very crucial stage in your life only because it's the best time to buy while you're young. The reason why I say that is because if you think about it, if you're 20 years old, remember this is a 30-year mortgage. By the time you're 50, before you know it, this home is paid off free and clear. So if you do decide to, let's say, retire by the age of 55, then all you have to worry about is paying for property taxes and homeowners insurance. You're going to have 5 years in between to be able to save just for yourself and then not have to just rely solely on Social Security or any type of retirement or investment funds that you may have. So again, it's right now is the time. Besides the 401k, besides the 403b, if you invest right now, you're definitely going to reap the proceeds of the sale, and what you put into your future right now, you're going to see it later on, and you're going to be thankful. Okay? If you purchased right now, again, you may be wondering, will I stay in the home for 30 years? Will I be there for 15 years? You don't know what your future holds. But one thing is for certain is that it is an investment, and it's an investment that you can either sell or you can rent, and you can use that as additional money each and every month for yourself and for another investment property or another primary residence for you and the family to come. Okay, so the important thing is that you're here now. You're listening into what you need to do in order to be able to move forward. And if you're here now, is because you're truly contemplating in purchasing a home. So think about the first step, second step, third step, and so on and so forth, on what you need to do. So you have to be organized. One of the other items that I do highly recommend for you to do is do your homework. I mean, besides knowing how much you're able to afford. Let's say you're able to afford the 50% debt to income ratio, the back end ratio, but only you yourself knows how much is it realistically that you're able to afford. Are you able to afford $1,000? Are you able to really afford $1,200 per month? Because remember, you also have other obligations such as, the cell phone, you have cable, you have to pay maybe the lawnmower or the lawn person, or you have the water, sewer, and trash bill. So there are other bills and maintenance fees. So there are other bills that come along with becoming a homeowner. So it's important for you to take a look at your budget analysis, take a look at your needs versus wants for right now, and eliminate the wants. Because if the goal is to be able to put as much money as a down payment as possible, then you really need to hone in on your expenses so that you're able to accomplish that goal. Okay. Another free tool is, again, going with receiving counseling from Navicore Solutions and GreenPath. You're able to also set up appointments with them. So let's say you decide to speak with Navicore next week, and your credit score is not up to par, or you really need to still continue to work on your student loans or credit cards. Well, they'll give you a client action plan, and then you can schedule an appointment another month from that date. And then they can pull your credit again and see where you are at that point. Now, when they pull your credit, it's not going to affect your credit score because they're not a financial institution. They're a housing counseling agency. So that means that when they pull your credit, it's safe. It's safe because it will not affect your credit score. Now, if I pull your credit for mortgage purposes, it will negatively impact you because it's for financial reasons. Okay? So if I were you, I will definitely take advantage of Navicore and GreenPath or GreenPath because they'll be able to also help you individualize a client action plan specifically for your case scenario and what you need to do in order to become mortgage ready. You'll have that counselor by your side. Okay. Now, tip number 2 to be able to save for the down payment. Most of us don't pay cash for our first home. In fact, 98% of millennials buy with a mortgage. That's why it's so important to have a strong down payment, not only to lower your interest rate, but also to help you pay off your mortgage even faster. So we recommend putting down maybe between 10 to 20%. If you have 20% tucked away, you definitely bypass the private mortgage insurance. That's the PMI. Additional insurance lenders may have that protects them if you stop making the mortgage payment. So that means if you put less than 20% down payment, then you will have that PMI. PMI may be maybe between 25% to 33% of your loan. So let's say that it costs you maybe an additional $100 or $150 a month. Now, the good thing with a conventional loan is that once you reach about 22% equity, then that PMI is eliminated, which in turn will reduce your mortgage payment. So let's just put that in layman's terms. Let's say you find a house for $100,000 and you don't have the 20%. You only have 5%. So that means that you're going to finance $95,000. So that means that you will still have to come up with, or start paying down the principal to maybe $78,000. When you bring the loan down to $78,000, then that means that your PMI will be eliminated, okay, without having to refinance. So if you're still saving, you must be patient and stay on course. Keep saving. Start with a clear plan. Know how much house you can afford. Stay motivated with a goal tracker, such as money management, and with a smart plan like this in place, it can take less time than you think. If you don't have 10 to 20%, it's okay. You can have between 3 to 5%. It's ideal to have 10 to 20, but it's okay. You can have between 3 to 5% as well. Okay, which would mean that you probably won't be able to borrow as much, but you'll be able to purchase your home. Number 3, stand out in a competitive market. So if you've already paid off your student loans and saved for your down payment, then good work. The next step is to get into the housing market. In the past few years, the housing market has had a shortage of sellers, which has not only raised the prices of homes, but also has caused competition amongst buyers. Now, the Gen Xers are typically buying more established homes instead of starter homes. So your competition is other millennials and your parents. Follow 3 simple steps. Get pre-approved, act decisively, and be human with the seller. So a lot of times I found that buyers, when they go ahead and they meet the seller, they build a connection with them, which will then in turn give the probability of them accepting your offer rather than other offers for people who they really haven't met. Okay. Remember, these sellers typically have sentimental values for their home, so that's why it's always important to possibly get to meet them if you can, but if you can't, it's okay. Now, let's touch upon get pre-approved. A pre-approval letter can only be obtained by us, by a lender. So that's when you prepare yourself. You give me, let's say, the 30 days pay stubs, the 2 months bank statements, the 2 years taxes, and that's when the underwriter reviews all of these documents, okay, and they approve you. So if you obtain a pre-approval letter, then you're ready to buy, okay? Standing out in a competitive market. So first, get pre-approved. As I mentioned, a pre-approved loan means that your lender has looked over your finances and decided that you can cover the down payment and the mortgage payments. Act decisively, so you have to do everything to keep this process moving, meaning you have to be in good communication with your realtor, with your loan officer, and if there are any down payment programs that are going to be applied, that you are applying for them in a timely manner. And be human. Selling a home can be emotional for a homeowner, so you never know how far things like a personal letter can go. So that's what I was talking to you before about. Writing personal letters is definitely a great option because this way the seller can get to know who you are and where you're coming from and why this property is so important to you. By the way, some people I've seen have actually even included a picture in the letter if they haven't met the seller. So that's definitely another option. Finding an affordable house in a seller's market. So another challenge facing millennials is the rising value of homes. Right now, they're a little bit high, but they're doable. Compared to also the interest rates. Rates are really low. So for many of us, especially for those that have just managed to pay off student loans and land, a stable job, rising market prices could be the most frustrating hurdle we face. So fortunately, the housing market it's beginning to slow down. NAR predicts a 1 to 3% growth in housing prices this year, which is far less compared to the 5 to 7% annual growth over the last 5 years. Our best advice then is patience. So once you start shopping, don't give in to the temptation to stretch your dollars and buy a home that's out of your price range. So although you fall in love with a property, do not go above and beyond your price range because remember, this is a 30-year commitment, okay? And you're not only going to live in this property, let's just say, but you have to think about the rest of the expenses that come along with it, okay? Number 5, gain experience with the home buying process. So familiarize yourself with one of the best things you can do as a first-time home buyer. And that's basically what you're doing right now. You're familiarizing yourself. Work with experts. So that's why it's extra important for millennials to work with experts who know what they're doing. Look for an agent who brings at least 4 years of experience to the table, one who knows the market well enough to find a great deal on the home that's right for the buyer. Okay. Also know what makes a good agent. Partner with a real estate professional who has the heart of a teacher and takes the time to listen to your needs and answer your questions. A good agent is more concerned about your bank account, not theirs. Okay? So be very, very, very careful because a lot of agents, what they do is that they tell you to bid for more just so that their seller commission can be more money. Okay, they can pocket more money. So a good real estate agent thinks with the heart, and thinks and protects you for your best interest, okay? Also, ask questions. Don't know something or you're curious about a certain topic, ask. Do not stay shut. Never be afraid to ask any questions to qualified individuals. The more you ask, the more you will know about the housing market you are looking into. Do not go into this market blindly. Do your due diligence and research. Ask your questions. Write them down as soon as you have a question, maybe on your phone or on a piece of paper, so that once you speak to the professional again, you're able to ask the questions necessary. Okay, because I know that a lot of times you have so much going on, sometimes you forget the question that you're about to ask. So it's always important to just jot them down, and once you see the professional once again, you just ask, okay? And write down the answers because sometimes you just forget, okay? First-time home buyer programs. Let's dive into this really quick. These programs will help you during the purchase of your first home. Not everyone has the same type of first-time home buyer program, so this is something that is important for you to learn about. With us, we do have the home buyer savings. So if you're not ready to purchase right now, let's say it's going to take you about 10 months to purchase, this is something you can consider. So it's $1,000 credit towards your closing costs. So it's 4 easy steps. to start saving and to earn your reward. We're going to review those 4 steps in the next slide. Okay, so sign up for Green Path's home buying, counseling, and education program. Okay. Number 2, you can pre-qualify for a mortgage by contacting us here at Greater Alliance Federal Credit Union. Then you will open up a home buyer savings account and save a minimum of $100 for at least 15 months. That's the max. So it's between 10 to 15 months. Okay. So the way that you do it is that every month, once you start saving the $100, at the end of the term, at the 10th or 12th month, we will reward you with $1,000. So we're going to match that up to $1,000. Okay, so you're going to receive a $1,000 credit on the closing costs with your Greater Alliance mortgage. Okay, now we also do have the Home Ready mortgage. It's a Fannie Mae Home Ready product. So remember the 3% down payment that I was talking to you previously? This is what I was referring to, okay? So it's just basically financing 97% of the loan to value, which means that in turn you can only put 3% down payment. So in order for you to be able to qualify for this program, you don't necessarily have to be a first-time home buyer. But in this case scenario, a first-time home buyer is considered to be, let's say, for instance, someone who doesn't currently own a home. So we don't use that 3-year rule here. So what that means is that you could have owned a home, let's say yesterday, sold it, and then you are considered to be a first-time home buyer today. Okay. With the Fannie Mae Home Ready program, cancelable mortgage insurance does apply. So that means, let's say, for instance, you've reached the 22% equity. You do have that option of eliminating the PMI, okay? With the program, we also allow gifts, grants, community seconds, and cash on hand permitted on as a source of funds. So let's say, for instance, your mom decides to give you $5,000, or let's say they give you $10,000. We do allow those cash gifts. Okay, let's say, for instance, you qualify for a down payment assistance. We can also apply that on this loan as well. Also, non-traditional credit is also allowed. Okay, we also support manufactured housing up to 95% home style, renovation approved lenders up to 95%. So just basically with the Fannie Mae Home Ready program, what's important for you to know is that it'll allow a 3% down payment. The mortgage insurance will be reduced with this product to 25%. So usually with a conventional loan, it's typically 5% down payment, and the mortgage insurance will cost you 33%. But with the Fannie Mae Home Ready, it's 3% down payment and 25% mortgage insurance premium. Okay. Okay. So we have a few benefits of the first-time home buyer grants. So feature number 1 is that low down payment with us is as little as 3% down payment. We do have the first-time home buyer grant available through New Jersey Community Capital and the Address Yourself program. So that's up to $5,000 to help you with the down payment, okay? In order for you to be able to qualify, you have to have at least $1,500 of your own funds, okay? Meaning that you have to have saved at least $1,500. Feature number 3, you must complete a home buying counseling offered through the Address Yourself program. So that's about an hour long. You speak to Navicor Solutions, and they'll be able to provide you with a certificate of completion. Again, those are services that you don't have to pay for, okay? Now, the grant must be used for a mortgage through Greater Alliance. So it's not like you can get this grant and go with someone else. No, you have to use the grant with our mortgage. And feature number 5 is that you have a reduction in the mortgage insurance, like I was telling you previously. So it's at a 25% reduction. So if you're planning to buy in Hudson, Essex, Bergen County, Middlesex County, Ocean, Cape May, so this $5,000 grant applies to all of the counties that are touching the Atlantic Ocean. So there are 9 of them. Okay, in some instances, we can obtain more than $5,000 as down payment assistance. Okay, I've used up to $8,000, up to $9,000 in down payment, but again, it all depends on the necessity of the borrower. What's great about our programs as well is that you can double dip. So let's say you qualify for the New Jersey Community Capital through the Address Yourself program, and let's say, for instance, you qualify for $5,000 with us. Then you can also double dip, and if the county has one available, you can also qualify for theirs. And let's say if it's $5,000 through the American Dream, you can add the $5,000 plus our $5,000. That's $10,000 that you can put as a down payment and for closing costs. Now, upon CAPC acceptance, we're going to talk about our CAPC properties. CAPC properties are properties that that are rehab. So CAPC purchases properties that have been foreclosed, okay, and they buy a pool of them. So once they purchase these properties, they rehab them. So they make them brand new with stainless steel appliances, granite countertops, brand new bathrooms, brand new floors. So the property is turnkey, and it's sold back at foreclosure cost. There's some properties that we can apply a $48,500 grant to reduce the price even further. So you can research those properties by going to integralrealestate.com. Okay. So upon CAPC's acceptance of the real estate contract, buyers will complete a CAPC demographic survey. So I will handhold you through the process of getting the offer accepted, approved, and we will go through everything that CAPC will need in order to make this loan qualify. CAPC will then provide a buyer with a list of lenders who participate with the grant, us being one of them. Okay. Because, obviously there are deed restrictions. So in order for you to be able to qualify, a complete homeownership counseling course through a HUD counseling agency has to be provided. So you have to obtain a letter from HUD approved agency that confirms the total household income. To our right, you're going to see what is the income requirement for you to be able to qualify for one of these CAPC properties. Okay, so if you live in Bergen, the total income has to be $122,760, for instance. Okay, so as you can very well see, it's easy to qualify for the property. Okay. One other thing I want to touch upon with regards to the CAPC property is that you have to live in the property for 15 years. That's another requirement. Okay. So let's talk about future webinars, and you can certainly register for the webinar on the 10th of October. We're going to have what is better, home equity loans or HELOC loans. So sometimes individuals don't know what type of loans they should apply for, what is better for them. So we have this webinar on October 10th that would be able to decide for both of them. On October 23rd, we're going to have when and when not to refinance your mortgage. Okay.
And with that, we are at the end of the presentation. Now, we went a little over the time limit, but, we will still have the Q&A session now. So if you have any questions, feel free to answer it and ask those now. We'll give maybe like 30 seconds. Currently, I don't see any questions in here, so I don't want to waste too much of your time. So actually, I'm just going to continue. If you do have any questions, though, and you didn't get a chance to ask on the webinar, feel free to reach out to us. You can always, you're going to see Jasmine's email in a second. She's always available for you to email her too. So you can always reach out to us or give us a call if you have any questions outside of this webinar. Um, and then I just want to let you know that right as the webinar will end, you'll actually be prompted to fill out a survey. While we really do appreciate you filling out the survey because it helps us make these webinar experience better, we're also offering you a chance to win a $25 gift card for filling that out. So it's a win-win. So again, you'll be prompted that once this webinar ends. So I would really appreciate if you had a chance to fill that out. And lastly, we really appreciate you attending and taking the time out of your day to checking out this webinar. Like I mentioned before, you will get a copy of this webinar sent to your email, and we'll also be uploading this to YouTube. This is a good opportunity to follow us on Facebook, Twitter, YouTube, and Instagram, where we post really good content, especially for home buyers. Below is Yasmin's contact information again in case you need to get in touch with her. And you can always visit our website or call 800-963-1937 if you would like to schedule an appointment with one of our mortgage experts. So thanks again for attending, and we look forward to seeing you at our next webinar.